This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, Michael Covel. Not filtered, raw, honest. That's my passion. My guest today is Eric Crittenden. Eric is with Longboard Asset Management, also Longboard Mutual Funds. Eric has been on my show twice in the past and was a featured prominent trader, along with Cole Wilcox, in my book, The Little Book of Trading. Today, as typical with Eric, because Eric can go wide and deep, we cover a lot of territory. I hope you enjoy this conversation with someone that has a great bit of insight when it comes to systems trading. I guess I'm reaching you in Arizona. They've let you out of the machine for a little bit of fresh sunshine with me, I assume.
Yeah, twice a day. They allow me out of the box to get some sunshine and air.
How goes life? How is everything?
Pretty well. No complaints. It's hot and sunny in Phoenix, as it typically is this time of year. How's life? Are you in Vietnam?
I'm in Saigon, so it's hot and sunny here. Probably not as hot as you guys. Probably high 90s, somewhere in there. But the humidity is a little rough sometimes.
Worse than what you experienced back in Virginia?
It's like, I guess mid-Atlantic states that you might get in July and August, the same thing you would get in Florida. So just, it's pretty sweat weather, I saw a guy last night, a friend of mine, and he was going to some play or something. He was a British guy, and he had a full suit on and a tie and a shirt. And I just looked at him and I said, are you kidding? How are you you're going to be dripping. I don't know how you could do this. So I've not yet put a tie on in anywhere in Asia. I don't think I can. It's against my body constitution.
Hey, I can agree with that. I'm not a tie guy. I'm probably the only guy here in this building that doesn't wear a tie.
You know what? See, that's that alone puts us on the same page. Hey, listen, let me jump right in. And I was thinking one of the first areas that I'd like to just touch on, what has changed? Not necessarily about the company yet, because we're going to get into that, and I want to talk about where things stand in Longboard and kind of work people. We're probably going to start in current day and work backwards a little bit so for those people that have not heard the Longboard story. But what's changed about you, Eric, in let's say the last dozen years? Because you had a really strong understanding of these styles of trading and whatnot going back a long time. But what do you think is the single and beyond, before we even get to like the different structures that your products are delivered in, but for you personally, what do you think has changed in you in the last decade?
Well, that is an interesting question. I've never been asked that question.
I try to come up with these things on the fly just to put people on the spot and make them really.
I like it. I would say recognizing how important humility is in this business. When I first started trading stocks and derivatives and whatnot, probably back in 1997, I had a high level of confidence in my ability to get good results. And over the years, I've realized that having respect for risk and developing and honoring realistic expectations is a tremendous asset. And it is the common denominator that I see amongst, the old guard, people that survive and thrive over long periods of time in this business. For that reason, I'm thankful that I'm comfortable with being humble and having realistic expectations. And that's a slow change, but it's been probably the biggest change since I was in college or, freshly out of college and just started trading.
And that can be tricky though, too, because so here you are going through that change and you're having that more potent understanding about humility, but then new clients or new people that come into your life, they might not yet have that full understanding about the markets and humility and expectations. So here you start to go in this long path to get there, but maybe not everyone else in your world is there yet with you.
Choosing who you do business with is going to affect that relationship. Here at Longboard, we spend a lot of effort trying to find the right people to do business with. That makes a big difference in your ability to not have conflict and to be free to do the right thing, to be free to make good business decisions. So, picking the right people, targeting the right people for business relationships can really impact that.
Now, here we are. We're going to talk. A good part of our conversation today is ultimately, you're in the fund management business. It's about making money. But here we are. We start this conversation off in a way where people are probably thinking, or some people might be thinking, relationships, personalities. Hold on. This is all about money. Well, it's about money, but, right?
Well, yes. The relationships and things of that nature play a very large role in your ability to sustain your trading over time. Yeah, at the end of the day, our job is to generate a compounded rate of return, take the appropriate amount of risk, and do that in a way that's sustainable. But trust is a big issue. We all know that after Bernie Madoff, and lots of different hedge fund managers have blown up over the years and decades and whatnot. So trust is always a very material issue. And it's one that we have to deal with, and you have to take care of that first. You can't get around to the trading and sustain it through time if you don't have clients.
I want to add something there. As you mentioned Bernie Madoff, I know you were not comparing yourself to Madoff, because just for the audience out there that might not be familiar, Bernie Madoff was an entire scam. So that was you guys are a quality operation, running a legitimate product. He was absolutely not doing anything legitimate.
I agree with that.
Yeah. Hey, let's jump into a core topic common to both of our worlds, and trend following. And we've spoken many times on this program before, but where do you see trend following today? It's kind of an odd question coming from me. The way I see it, I think of there's timeless aspects to it. The human condition is always going to be reflected and manifested in trends. But they're going to be, different practitioners are going to have different augmentations, different ideas. Where do you see trend following today?
To me, trend following hasn't changed at all. What's changed are the participants and the perceptions or the framing of trend following. When we look at, financial time series data going all the way back to rice futures in Japan, centuries ago, I look at the time series data on a daily basis, and it doesn't look any different to me than it did, say, 20, 30, 50, or even 100 years ago. There's certainly more of it today. But the nature of the trends, the descriptive statistics of the trends, at least for long and medium-term trends, they haven't changed very much at all. There has been more noise. As markets become more efficient and more liquid, you do end up seeing more noise on the very short-term frequencies. But that's a natural and expected phenomenon. So I would say the perception of trend following is an emotional thing. It's a volatile thing, and it's a function of recent results. So if we rewind the clock and go back to, say, the fall of 2013, the perception of trend following was somewhat negative, because a lot of people entered the commodity trading advisor space or the managed future space on the back of what happened in 2008, or back when trends were so persistent and so volatile, and they got below average results. And I think that embedded a certain degree of skepticism in the efficacy of trend following long term. But when you look at the data underneath the hood like I do over long periods of time, things haven't really changed much at all.
You mentioned time series data, and I'm curious, is just kind of to interject at this moment in time, if you might offer some thoughts or some wisdom. So time series data is often the way in the academic field that you will see trend following described. But there's been a ton of research and many funds these days that are talking about momentum. So you have momentum from a relative standpoint and a time series standpoint. I'm curious your perspective on the relative momentum and the advent of so many products in that area.
If you talk to 10 different people, you'll get 10 different definitions of momentum. The engineer has his or her definition, and the CFA has yet a different definition. Momentum to me is simply a way to compare a time series now versus what it was doing in a previous period of time. People that analyze financial time series data, whether it's corn or gold or the S&P 500 or Netflix stock price, what they see is that there's a tendency for profits to accrue after some momentum has been built. And they conclude that momentum is a factor that one could use to generate abnormal profits in markets. I would not characterize what we do as momentum investing. It's a cousin of momentum investing. But trend following really just looks at trends trigonomically from a geometric perspective, or looking to see if a market is generally moving higher or if it's moving lower, or if it's not moving either direction, and identifying a trend. Momentum is measuring something slightly different that is very sensitive to the time period upon which it's calculated. You do see quite a few momentum products. They come and go. Back in 2007, we were running our long-short equity hedge fund, and we had a lot of competitors out there that people associated what they did with what we did. But what we do is pure trend following, and what they were doing was momentum investing. And one of the side effects of momentum investing, considering how it's typically employed, is that you end up concentrating your exposure in the most volatile assets. For example, you may take the S&P 500 and then calculate the returns for each of the stocks in the S&P 500 over, say, the last 6 months. And then what you would do is identify the 20 stocks with the largest percent return and go long those stocks. And then you would identify the 20 stocks with the most negative return and then go short those stocks. And if you repeat this process every 6 months, what you'll find is that you're generally taking positions in the most volatile stocks. A quiet utility stock, generally speaking, doesn't have the returns to ever end up being one of the most strongly appreciating stocks or strongly depreciating stocks. So momentum investors miss a lot of the less volatile securities in the middle. Trend followers, on the other hand, at least the way we employ trend following methods, we're agnostic to the volatility of the underlying instrument. So we will take positions in all instruments according to the direction of their trend, regardless of whether they're the strongest instruments in the market. And then we will make up for the lack of volatility with more exposure. So for a highly volatile stock like Tesla or Netflix, we will have small exposure. And for a less volatile stock like Sherwin-Williams or ConAgra, we will have more exposure. So there's some subtle differences, but meaningful differences between a trend-following approach and a momentum approach.
Yeah, thanks for defining that, because I think for many out there, if you just read the financial literature and you see the news, there seems to be, at least for the way that things are written about, these terms are used interchangeably, and they're clearly not the same thing. And I can only imagine there's a good deal of confusion. Maybe people don't even know they have the confusion because these things are often blurred by perhaps even practitioners in the media. So I think you outline a nice, hey, this is the way to think about it. Here's the differences. And I think that's very useful.
Yeah, I think that momentum investing comes with a connotation of highly risky, because the volatility of the underlying assets tends to be higher than average, whereas trend following need not be that at all. In fact, trend following can be calibrated to have lower volatility or lower skew or lower drawdowns than investments that most people are already comfortable with.
Now, of course, you say momentum can be thought of as highly risky, and I'm sure some people in the audience are thinking, well, hold on. This guy, Eric, doesn't think his world is highly risky. Now, you just outlined really quickly how things can be tuned up and tuned down. Why don't you take on the notion head on? Hey, Mr. Crittenden, you are highly risky. You are practicing a trend following style trading across many different types of approaches that customers can invest in. Why is this not highly risky?
Risk is something that you get to define yourself. We have a risk budget that is different depending upon market conditions. So in highly volatile, highly correlated market conditions, our risk budget will be lower than average. It might be something like 10 or 12%, meaning that's how much we expect to lose if every position in the portfolio turns into a very significant loss and we have to close them all out. However, in a different environment where you have lower volatility, better trends, better trend quality, lack of correlation between sectors and assets, well, then our risk budget might be something larger, like 22 or 24%. So risk is something that you can control through position sizing, how aggressive you are with the size of your positions, and how aggressive you are with controlling that risk through time. The practice in and of itself is neither risky nor riskless. It's how much you allow your exposure to be while you're managing those assets.
You know this about yourself. The way you describe risk, you're so even-keeled. I'm not saying emotionless, but you view this as a scientist, as an engineer. This is just a puzzle. This is a game. These are rules. These are numbers. And you can hear it clearly in your voice. You're not allowing this. This is not a casino to you. This is a rigid, practiced strategy that you do every day, and you've thought through possibilities. You don't know everything that's going to unfold, but you're very pragmatic about this.
Yes, I would say that my personality, I'm not particularly emotional. But like you said, I'm not emotionless. We run our investment methodologies similar to the way an insurance company would manage its liabilities. Each position is considered for the amount of risk that it's subjecting the portfolio to, and we manage that through position sizing. So if we're talking about a short-term interest rate contract in Europe that has very low volatility, our position size might be quite large. But if we're talking about a corn contract during the planting season or the harvest season and the volatility is high, well, then our exposure will be commensurately low. We look at all of the positions in our portfolio every day, and we estimate the catastrophic risk in each one of those positions. And then we look at the assets that we have under management, and we consult our risk budget at the time, and then algebraically simply solve for the appropriate exposure in each position. And that's a daily circular process that gets run twice a day. It takes the emotion out of it. We're able to calibrate our risk to be in line with what is appropriate, what allows us to compound at a reasonable rate over long periods of time. And you're right, it is not a very emotional process. Some would describe it as boring. I find it to be exhilarating. And it's run in a very disciplined, insurance-like manner.
And these are choices. You're making particular choices on your risk budget, your targeted type returns. For your firm, for your client base, you are constantly working on what's the best fit, product market fit. That's your, it's not a guessing game. You're making particular decisions to appeal to a particular audience.
True enough, yes. The program was designed to accommodate today's investors by producing a reasonable compounded rate of return that is fundamentally unrelated to a traditional portfolio made up of stocks and bonds. And then our money management philosophy forces us to control the risk. It actually forces us to balance the need to control risk against the need to generate a reasonable compounded annual growth rate. It's a formula-driven process. It's a set of rules that everyone's agreed to. They're very clear. They're very simple to implement. It just requires discipline, attentiveness, and realistic expectations.
Over the decades, Eric, we've both seen this, the trend following world. Once you've got the trend following strategy And then for investors that want to invest, there's typically been a structure governed by the CFTC, the NFA, something called a commodity trading advisor. And there were pools. And this was the primary way that the individual investor could make an allocation, could say, I want to participate. There's often some of those rules were often restrictive for the average investor, and it didn't necessarily, except for the extreme high net worth, it didn't necessarily make it easy for people to make a decision and then make an allocation. Why don't you talk about Longboard's entrance into mutual funds and how that has worked with trend following?
Right, Michael. That's the world that we came from, was the limited partnership hedge fund world. And, before 3 years ago, all of our clients were considered high net worth clients and or institutions. We saw an opportunity to build a bridge between the managed futures world and regular investors, everyday mutual fund investors, anyone with $10,000 to invest that is looking to capture these risk premiums that are uncorrelated with what's already in their portfolio. So we spent a long time analyzing the feasibility of doing that. And there's a lot of different things you have to look at: the regulatory risk, the fixed costs of running a mutual fund, the operational costs of running a mutual fund, the compliance issues, the distribution, the way that the fund is marketed and sold and serviced. We spent probably a year and a half and quite a bit of money making sure that this was a viable business decision and something that we wanted to do. Because when you make the commitment to running it in a mutual fund format, there's a certain set of fixed costs that you're signing up for. So we went into this with our eyes wide open, and we're very confident that it was a good business decision. It wasn't guaranteed, but it was a good business decision using the information that we have at the time. And after 3 years, I can tell you, I'm very pleasantly surprised at how smoothly it's gone. None of the things that we worried about materialized. It's gone very smoothly. We didn't have to water the strategy down at all to get it into a mutual fund. I can talk about that later, but it's beyond the scope maybe of this conversation. But it's gone very smoothly, and I'd say the biggest challenge thus far is explaining what it is we're doing to clients, why it works, and what's in it for them.
I mean, difficult to explain in the sense that you're back to explaining trend following?
Yes, that's part of it. That's a big part of it. But mostly the industry, the financial advisory industry, is slow to change. It's skeptical. Frankly, there's a lot of bad product in the mutual fund world, and everyone knows it. There's a lot of products that get rolled out and they don't work and they get closed down. There's a lot of survivorship bias baked into the mutual fund world. That's why trust, credibility, and relationships are so important, because there's over 20,000 mutual funds. There's too many for people to do extensive top-down due diligence on. What we found is that targeting the right kind of client and convincing them to carve out a piece of their life to investigate this world of managed futures is the best way to move forward. And it's worked well for us so far.
So in terms of strategy, though, even though you've chosen a different vehicle than what we've talked about historically, the CTA space, and there's still quite a few successful CTAs out there, but in terms of vehicle choice for Longboard mutual fund, that's not affected your strategy implementation of trend following.
No, that was a very important thing to us, to not cut corners or water the product down. Earlier, when I was talking about that year and a half due diligence process by which we made a business decision, that was probably the primary component, in that we want to be intellectually honest. We really needed to figure out whether the strategy could be run in a non-diluted, no cut corners type of way. And in this regard, we got lucky in that our approach, we are long-term trend followers. We are proactive, risk-managed, long-term trend followers. And because of the way that we participate in the markets, we tend to not use as much leverage as most CTAs. And we tend to not trade as actively as most CTAs. We really hold on to our winners for a long period of time, and we proactively manage the risk as volatility increases. So if you look at our leverage use and our open risk and our trading costs, if you plot those as a time series on a chart, you'll see some lines that pretty much just go sideways. They go up and they go down, but they don't spike into extreme territory that would violate the rules that one has to operate inside of in a mutual fund. We're having to deal with the Investment Act of 1940 and all the no action letters that have come out over the last 50 years. And you have to operate inside of the confines of those rules. Like I said before, we just got lucky in the sense that our preferred approach fits pretty nicely inside of those rules. Not all trend following approaches are going to.
Description. Is this called the Managed Futures Mutual Fund? Is that the common descriptor that the investment advisors are referring to your type of strategy?
It is, yeah. So if you go to Morningstar or one of these other places, they'll have a managed futures category, and in there you'll see 20, 30, and sometimes, some cases, 40 different funds.
Okay, I promise not to go off on a tangent and have debates about the term managed futures anymore, but geez, I thought it was supposed to be killed at some point in time.
Yeah, I know.
Let's talk about the size, the growth of Longboard and in this new vehicle. Where have you guys grown to so far?
Well, 3 years ago, when we launched, we had 0 in the mutual fund. And now I believe we just crossed 300 million in total across. We also have another mutual fund, the Long Short Equity Mutual Fund, which just launched a couple months ago. So we're just over 300 million now in total assets.
We can go any direction on this podcast, and I'm asking this next question more of a curiosity standpoint. Talk about that growth from 0 to 300. Now, there's some people listening that might say, hey, Mr. Covel, I don't care about the strategy and technique of the growth of this. I just want to make an investment. Okay, well, you can figure that out really fast. But I'm curious, how have you seen that growth? What has happened along the way? What has been the strategy? I mean, that's a significant amount of money from starting from 0. So what has been the strategy to get you to that point so far? And how do you expect growth to continue?
Well, the strategy's changed a little bit. Coming from the hedge fund world, there's a couple of different ways you go about raising money. Those do not work in the mutual fund world. In the mutual fund world, you have to scale your message, and then when you identify what we call the sweet spot client, we have a sweet spot client, somebody who fits a certain profile that would make a good business partner long term. And the idea is to have your prospecting locate those people and just focus your time and effort, your precious time and effort, on only those people. And at first it's lumpy, right? You go from 0 and then you talk somebody into putting $20 million into the fund, and then a few more million trickles in, and then another $20 million client, and then a 10. And then once you get up over 50 million, some people that were sitting on the sidelines with $1 or $2 million will start to dribble into the fund. And then once you get up over 150 million, a lot of people that were sitting on the sidelines essentially capitulate and just buy the fund. And the bigger you get, the easier it is to get people to put money into the fund. But I said that the strategy has changed a bit. There's a little bit of a learning curve when you transition from hedge funds to mutual funds. We've been open-minded, we've been humble about that, and we've adapted as needed. And it's really started to pay off for us in the last, I would say, 9 months or so.
And nothing inside of the mutual fund in terms of strategy, trading strategy, the trend following strategy, that has not had to change. And the instruments you're changing, you've literally it's just been a transition to a different vehicle, CTA to mutual fund, and all that insides, so to speak, that has not had to change.
That's correct. The engine hasn't had to have to change at all, just the body on the outside. And that was by design. We've been intellectually honest every step of the way with people. We have $1 billion in capacity in this program without having to make any modifications. That's the way we built it. We're good to $1 billion. And then beyond that, there are some very minor modifications that won't affect performance very much. But, you will run into a brick wall with position limits and liquidity in some of the smaller commodity markets once you get up over 1.3, 1.4 billion.
As you mentioned these numbers, for those people out there that might be listening to you and thinking, I want to be the next Eric, you're not being cavalier with these numbers. I think you're being very, this is how it is, so to speak, that, for a new advisor out there just getting started, raising a significant amount of money, 50 million, that might seem like, oh, that's a big number. But the reality is, and I'm sure you've thought this through in many ways before you got started. You were not naive to the point that you needed critical mass to then get the next tranche of people interested in the product. You knew this before you started raising money. It wasn't like a surprise that you got to one level and you're saying to yourself, oh, wow, we're learning something entirely new. I mean, obviously you're learning along the way, but you had a reasonable expectation that there were going to be these certain thresholds you had to cross to get people interested in what you do.
That's true. We did have a plan, and the break points in real life have been pretty close to what our expectations were going into it. And $300 million is a tiny mutual fund. It's not a very big mutual fund. And when we look at the space, and there's literally trillions of dollars available, and there are hundreds of billions of dollars in inefficiently allocated assets that don't have any true diversification in their portfolios, I mean, the sky's the limit. I'm kind of sad that our capacity will start to get strained at 1.4 or 1.5 billion just in this particular program. I mean, there's other things that we can do to expand that capacity. But no, I don't think that those are unreasonable numbers. I have a high degree of confidence that $1 billion in this fund is attainable in the next 36 months.
I'm guessing, having moved into the mutual fund space, your understanding of competitor strategy or just other strategies in the mutual fund space has probably gone up quite a bit. I'm gathering once you get under the hood, so to speak, and you've already kind of hinted at this, quite many strategies in the mutual fund space are just what? I mean, it's really not product that people should have their money in. But it almost sounds like, I've always, the criticisms over the trend following space in the CTA land over the years, I'd often hear criticisms, and many times you could really see and understand what a particular trader was doing. Their track record was very transparent, and you could kind of follow their strategy along, perhaps even for decades. It seems like in the mutual fund space that the transparency and the understanding of what people are doing exactly, they seem to have more cover, so to speak.
No, it's both true and false, depending upon which type of managed futures mutual fund you're looking at. So there's basically two primary types. There's the direct manager. Longboard is a direct manager. Natixis, AQR. These are firms that do all of the trading and the asset management themselves, and they offer their trend following program directly to investors via their own mutual fund. And in that model, you have a high degree of transparency, a very firm understanding of what the fees and costs and expenses are. But that model is actually the minority. Most managed futures mutual funds follow a different model that I refer to as the fund of funds model. And essentially what they do is raise money from investors and then send that money, or a big portion of that money, to their offshore entity in the Cayman Islands. And from there, they invest in total return swaps, usually through a European investment bank, to get them exposures to commodity trading advisors. And the downside with that model is that you have multiple layers of fees. You've got the mutual fund company charging, say, 1.5% management fee. And then you have to pay the financing fee for the swap, and that's usually 50 to 80 basis points. And then ultimately you have to pay the CTA their fees, which typically is a 2% management fee and a 20% performance incentive. So that's the big flaw in that model. It's such that if you roll those fees all up into one number, it can be quite high. I've seen it typically between 6% and 12%, depending upon market conditions. And that is pretty expensive, and it's a big chunk of the risk premiums that the trend following strategy is out there collecting. And in my opinion, it's simply too much. It doesn't leave enough for the end investor. Now, if we go back to the direct manager model, where transparency is quite good and the fees are much more reasonable, on the low end maybe 1.5%, and then on the high end closer to 3%, reasonable fees that don't really cut in too much to the gross returns of the underlying trend following strategies, and therefore sustainable.
I want to wind down talking about your new long short fund that you've recently launched, but I'd be amiss if I didn't have you on the phone to let you go back into some kind of hardcore details, because I have a feeling deep in your heart this is where you really love, and I'm curious. I guess I'm curious about a lot of things today, but I would just keep asking you questions all day long. Think back to the first moment in time when you realized the investment returns in either the strategies that you were trading or studying at the time were not normally distributed. And talk about some of how that was changing your focus and your understanding when you started to realize so many people out there, and this is a really big picture question, but that so many people out there were either stuck on purpose or just for lack of understanding in a normally distributed world. And all of a sudden you start to say to yourself, wow, these tales are really exciting. And this whole idea of the world in a normal distribution for investment returns is going to present me lifelong opportunity if I follow this path. Talk about that. That's a big open question, but you know where I'm going.
So that happened for me back in 1997, actually when I was a senior in college. I was in a class, a financial engineering class, and one of our tasks was to design a mechanical investing system and run it for, I believe it was 2 semesters that we were supposed to run it for. And like most people, my first foray into trading, I decided to build something that bought weakness. I designed a system that would buy stocks when they hit 52-week lows. It backtested beautifully. It made tremendous rates of return, and it was just created a great equity curve that was very encouraging. So I ran that system in real time for a number of months and just watched it hemorrhage losses just month after month. And it was literally losing money at staggering rates. Now this was with fake money, mind you. Meanwhile, so the real account with hypothetical fake money was losing money, but I kept rerunning the simulation, and the simulation was making money, which was very eye-opening to me. And it was because of survivorship bias was hiding the left tail of all the stocks that were going bankrupt and getting delisted. My response to that was to invert the system, and this actually took place, I can't remember if it was 2 semesters or 1, so it was either the second half of the first semester or it was the second semester. I simply inverted the system to buy 52-week highs and to short sell 52-week lows. And that backtested pretty well. I think it made reasonable double-digit returns with commensurate drawdowns of about the same as the compounded growth rate. Less impressive than the fake backtest that showed buying lows was profitable. But the real-life results closely tracked the simulated results on an out-of-sample basis. So I did some investigating and looked and saw that there were a lot of stocks that were going bankrupt and going down 80-90% and getting delisted and therefore dropped out of the database that don't show up in the simulation. And that's when it dawned on me that a lot of people that analyze financial time series data, they're not seeing the whole picture. And the scope of what's being left out is very high. In fact, if you look at the Russell 3000 over a 10-year period of time, what you'll see is that there's roughly 8,000 to 9,000 members in an index that has 3,000 constituents. That means there's a lot of change. And a lot of that change is stocks going down and getting delisted because they're bankrupt. And it also involves stocks that are getting bought out at a premium. So the right tail and the left tail, both are left out of your database if your database doesn't account for survivorship bias. So when you include all of the securities in your analysis and you're intellectually honest about it, you'll see that left tail, and it's much bigger than what academic models suggest. It's an order of magnitude larger. And you'll see the right tail. And the right tail is not that much bigger than what academic models suggest, because they typically follow a log normal distribution. But boy, I'll tell you, that left tail is definitely a lot left out. And that can be catastrophic and will be catastrophic to your investments.
I think that dovetails perfectly to where you guys have just launched a new product, a new long short fund. Talk about the strategy and the thinking behind the long short fund, because I have a feeling, a sneaky suspicion that philosophically, foundationally, it's rooted in what you just described that you first started to put together in 1997, your understanding of a large field of equities, survivorship bias, and left and right tails. It's the same type of thinking foundationally, isn't it? It's
the same thing. You're right. So the strategy has actually been around for almost 11 years now. We've been running it with our own money in our internal hedge fund since January of 2005. And the strategy is essentially identical to what we published in your book way back in the day and what you put on your website. I think you were the very first person to publish probably all of our research papers now that I think about it. So yeah, it is a classic long-term trend following system with proactive risk management, and it's applied to every stock in the Russell 3000. Anytime you get sector-based bull markets and sector-based bear markets, this program tends to go in there and capture those. And it's very different from a long-only equity program. It has a low beta and a low correlation, especially when the market's going down. But a lot of that's because of what we learned in the CTA industry about how to manage risk, how to limit losses, how to preserve capital, when to increase your exposure, when to reduce your exposure. Taking those concepts from professional global macro and global futures traders and applying them to common stocks was just something that we didn't see anyone else doing at the time. And it frustrated us, so we just went out and created our own product. And we've been running it, like I said, for almost 11 years, and we've been very happy with it. It's done exactly what it was designed to do, no surprises.
Eric, talk about the difference between the long portion and the short portion of this product.
So the long portion is very straightforward, right? We're looking at any and all stocks in the Russell 3000 that are in an uptrend, a long-term uptrend. So there's a lot of work that goes into keeping track of all these stocks. You know, the databasing behind it is somewhat complicated because you've got corporate actions, divestitures, mergers, cash dividends, buyouts, all kinds of things. But once you got all that accounted for, you have, approximately 3,000 stocks to look at. And then what we do is we make sure that we're long every stock that is in a long-term uptrend. And by long-term, we mean 3 years. We're looking at 3-year trends. We are going to be long all the stocks in the Russell 3000 that are in an uptrend at all times. The question is, how long? Well, for volatile stocks like Tesla or Netflix, our position size will be small. But for relatively quiet stocks like some of the utilities and some of the mid-cap value stocks, our position size will be higher. So there's some disparity between how aggressive we are with individual securities. But like with the futures program, we have a risk budget, an overriding top-down risk budget. And that risk budget is a function of market conditions. So if we're in a broad-based bull market like we were in 2012 and 2013, meaning lots of stocks are going up, there's a lot of trends, and there's some independence between these trends, and the volatility is reasonably low, then our appetite for risk will be above average. And we ended up making very strong rates of return during that period of time because we were using some leverage at that time because our risk budget was telling us to do that. However, if we don't see good breadth and not a lot of stocks are trending higher and or the volatility is higher than average, well, then our risk budget will contract and we will go in and reduce the size of our positions and control our risk. Does that make sense?
Absolutely. On the short side, though, you're not going after the individual equities. You're going more after an ETF or futures positions?
Yes. So we spent a lot of time studying the best way to get short exposure. And that can get complicated. There's a lot of pitfalls in shorting. It can be incredibly expensive. So if you want to short a stock, you have to borrow that stock from someone else. Your broker goes out and borrows it on your behalf. When you borrow it, you have to pay the borrowing cost. And the borrowing cost is variable. It might be 2% per year for a very liquid stock. It might be 60% per year for a less liquid stock. And for a highly shorted stock like Tesla or some of these other technology stocks that people are betting against, The borrowing costs, I've seen them go as high as 90% per year. You don't have any control over the borrowing costs. The shares that you're borrowing, there's a marketplace for them, and supply and demand works its magic. If they're heavily shorted and you can't find the shares, you have to pay up in terms of higher borrowing costs. We chose not to bother with trying to short individual stocks because you can get the same effect without subjecting yourself to those variable and potentially high borrowing costs by simply shorting broad-based index products like S&P 500 futures or Russell 2000 futures or the Russell 2000 ETF. And it's much more cost-effective. Operationally, it's much simpler. And the regulators can't make short-selling futures contracts illegal. So they can't take away your ability to go short. And when you borrow individual stocks and go short, your broker can call them away from you at any time when the rightful owner wants to share them or to sell them, which is very problematic because that tends to be when the stock's really going down in value. When you want to hold them, you can't because they're being called away from you. So there were a whole bunch of different reasons that were considered, and ultimately we decided to short using index products. So we have this long book of all the stocks that are trending higher, and we've got all of our position sizes nailed down, and then we go short S&P 500 futures for large cap exposure, S&P 400 futures for mid cap exposure, and Russell 2000 futures for small cap exposure. Now what happens is when you blend all this stuff together into one portfolio, you end up being net long all the stocks that are trending higher, and then synthetically you're net short all of the other stocks in the market because all of the stocks are in the index products themselves. So it ends up being a very cost-effective, very scalable, convenient method for running a long-short trend-following program on Russell 3000 stocks.
When you do a podcast like this, you never know exactly the audience, and I always instinctively know that there's some people that will be listening because they want to do it themselves, or some people that want to make an investment allocation to a manager. But you did raise a point, and if people have not listened to your prior podcast or they've not seen some of my works, they might have missed it. But you've been very generous. You and Cole have been very generous over the years with your research work, and people can go easily find that work on my sites in my world. Research papers, varying lengths. I mean, so if people really want to dig into the nitty gritty, it is out there. We can't read that stuff line by line on this podcast, but if people want to do some extra reading and really see the kind of research behind your work, it's available and easily found.
It is. We've written, I believe, 4 different papers and published them all on your website, and some of them are in the appendices of your books. And yeah, we like to share. We're not afraid of competition. I personally don't believe that anything's proprietary. I know that's kind of a radical statement. We really do believe that having discipline, realistic expectations, and however much wisdom that you can put together over the course of a career, those 3 things are the real proprietary component, is being able to stick with a system that you're confident in and represent it correctly to your clients and do a good job. If people want to go out and build an ETF trend following program or a small managed futures account, I do not begrudge them. I hope they're very successful at doing that.
One last question, Eric. We talked about it earlier, and I would love for you to define it for those people out there listening. What is a sweet spot client for Longboard?
They have realistic expectations. They're looking to make high single digit, maybe low double digit if we're lucky, returns. They want to diversify into risk premiums that are fundamentally unrelated to the U.S. stock market and the U.S. bond market. The sweet spot client is someone who's making business decisions for a long period of time. They're not trying to make a bunch of money this quarter and then move on to the next thing. They have a little bit of courage. They have some conviction. They're responsible. They just want to make a good business decision, and they need a true diversification vehicle in their portfolio. And they're willing to do their homework, meaning that we can't hold everyone's hand every step of the way, but we will definitely do the hard work to bring these people up to speed and make sure that they understand why we're doing what we're doing, why it works, and what to expect in the future. And then in turn, they take that and explain it to their clients. and it ends up being one big happy family. That's our business plan. It's worked for us so far, and we're very enthusiastic about it going forward.
Eric, I appreciate you coming on today. For people that want to find out more, I believe the best place to go would be longboard-am.com.
That's correct.
Easy enough to find. And like I said, definitely, if you've not seen the mini papers that Eric and his partner Cole have authored over the years, they're easily found. Definitely recommend the reading. Some great graphs and charts in there too. So and I think there's some color too. So this is not just standard issue academic fare. This is some interesting stuff. So I highly recommend it.
Thank you, Mike. I really appreciate it.
Eric, we'll talk again, sir. I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.